want to take notice. The positioning technically is not bad either. But boy, I'm waiting for things to sell off a little bit to get bullish. The thing is, you want the selling to get to the buying, right? We want to see that two-sided market playing out. That's always working best in our favor. But good to see you today. We got Tim, we got Secret Agent, Days Boy. We got Phil in here. Phil goes way back, Carlos. But anyway, let's get rolling. So let's take a look at the 90 Burr bands. We're going to see where the market is. So remember, I'm saying get through the selling to get through the buying, right? Because what we're looking at is volatility expectations. We crossed the Rubicon here. We crossed the ratio of 3-month to 1-month volatility on Friday. It was back above 1.2. How we got Teal Carter, we got Rock Bro, 77. Randy, good to have you. So we're in a position right now where, look, I mean, volatility expectations are hot, right? They're ramped up. How are you doing with that? Trains. So how do we deal with this? I'm like, this is not a great position to really load the boat on the bullish side. So for me, I'm like, I want to see the better position. Well, what's the better position? The better position is to get some selling and see when we're below 1, when the 3-month is less than the VIX. Now we're expecting what? Volatility to fall. So if we go back to the VIX here, is a low VIX bullish or bearish? So VIX right now, we're scraping the bottom down here at 15.5. Eric in Northport, he's a Ghost Print member now. This is easy to remember. It's got a lot going on. So Teal Carter says bearish. Yeah, we've been bullish, right? The move from 22 down to 15, we've been bullish. Now, does it mean we're going to sell off tomorrow? No. But the point is, it just points to the risk level right now is pretty high to the downside. And so again, it just, when the VIX is falling, it just says we've been bullish. The VIX doesn't tell you anything about the future other than you're looking at levels. Okay? Buy VIX at 30, sell VIX at 15. You probably want to buy the VIX at 15 and sell at 30 or 20 at 30. We walked through that on Friday as an idea. But the idea is when the VIX is low, it's something where the risks increases, and it doesn't always trigger this, but it is right now, right? Where now all of a sudden, again, the 3-month VIX is 20% higher than the spot VIX, the 30-day VIX. Okay, skew. What's skew doing? I think Don looked at this morning. Skew's at 147. There's a high degree of hedging. So again, institutions are expecting volatility to ramp up significantly in the next 30 days, and they're hedging aggressively. And again, does that mean they know it's going to happen? No. But again, it's like, why not position yourselves along with that sentiment? Now, here's the deal, though. At times, you do experience the pain trade. So, for example, right here, the pain trade, this last bit right here, pain trade was the upside, right? Even this last month right there, pain trade was the upside. I'm tracking institutional trading, right? Institutional activity in Ghost Prints. When it's a retail-driven market, yeah, we're going to take some swings on the retail side, but we're also taking some big positions. We're taking positions based on institutions. And so, again, this was the pain trade, this last gasp here. It's the reason why we had 19 positive trades here, and we had the last gasp that hurt, because the pain trade was the upside. That's where institutions were going to lose. Now, here's the deal again, right? The pain trade is still to the upside, right? You read in terms of institutions getting hedge funds, getting increasingly more short the market here. At some point, they will be right. And right now, we're projecting a 5 to 10% correction in the market. That's typical given the volatility conditions we're in. So I want to get bullish, right? I want to find some bullish opportunity. We'll look at one here in AEO. If you believe in Sydney Sweeney, I guess. I've never even seen a movie she's in, but apparently she's got good genes. But the idea is that we're in a position right now where the market's very extreme. And I'd love to see more of a pullback here. It's going to really set up for a lot of things that I look for in Ghost Prints from a sector level, high volatility or high beta as an opportunity. But we got to see this pullback, and I want to see the VIX to push above the 3-month VIX, again, going from contango to backwardation. Dirty Dan. Of course you think your movies are great. But anyway. So again, we're just in a position right now. We're laying low a little bit. It's not a bad deal. We've taken some we're taking some decent swings. When I say decent swings, normally at close spreads is 70%. But some of these spreads are pretty cheap. And I'm going to show you one in XLP. There's a huge trade today in XLP. And I'll show you how, someone mentioned it in Ghost Prince. That someone was, let me bring it, Bruce M. And so we talked about a setup there, a trade that you could do to kind of capitalize on the print today. But just realize we're just entering the volatility woods right now, right? I mean, it's like it's this. I doubt Sydney Sweeney would ever star in this movie, but now I forgot what it is. The Princess Bride. But the idea is, they enter those woods to escape. They got the rodents of unusual size and the pit of despair, whatever. I can't remember. But the point being is that this is kind of where we're at. We're in the volatility woods right now, and we ain't through it. There are rodents of unusual size, and you'll know it when you see it. Okay? Eric said had an AEO spread that was in the money until the hubbub over the ad expired worthless on Friday. Yeah, so again, AEO, that's a tough one to go bearish on. Why? Why is AEO a tough one to go bearish on? And I'm going to show you another stock today that might be a couple of bigger prints in some companies today. It might be hard to go bearish on. Why is it hard to go bearish on AEO? Yeah, it's very high short interest. So I generally look to go bullish on these stocks rather than bearish. Even though I'd love to short them, they're terrible companies in a lot of respects, but 16% of the float shorted, 2.5 days. It's not high, but comparatively, it's relatively high. Peloton, I tried to take a long earnings trade in Peloton. Could have closed it profitably. I wanted more out of it, but 21%, 5.8 days. I mean, that sucker may not be done yet, right? So I don't like going short these companies just because the pain trades the upside. And look at this. We're finally at 858 today. Should I have rolled? I had an $8 call on Friday expecting the short squeeze. They held the line at 8 until today. And today we're breaking out. Inconceivable. It should be the Princess Bride. But look at Peloton. I can't tell you how many times this has happened. Like you're a day late and $1 short, day early and $1 short because you got an expiration here, but Peloton's breaking out today. So I had a wash last week between cores, closed out for 130% before the earnings, and then Peloton finally breaking out. Should I have rolled? I couldn't have rolled the 8. The 8 was worthless on Friday. Should I have closed it here or should I have capitalized? And this is what I was thinking after the fact. Probably should have rolled when we just popped up here to 8. We had a small gain. I probably should have rolled that an extra week on Wednesday. That was my opportunity, and I blew it. That was my opportunity on Peloton. There was early in the day. The opportunity was there to roll this sucker, and it was fleeting. You had 5 minutes, well, less than 5 minutes, where it was trading about, up about 20%. I could have rolled it and just rolled it out a week. And then all of a sudden, look where we're at today. Peloton, right? So, I mean, if I had stayed on top of it and said, okay, maybe I'll just buy another option, put another 20 cents out there, 30 cents out there, right? This would have been a great opportunity at the 8 strike. Okay, now we're 54. Who knows? When we go to 11. So this is the potential, right? So you have crash risk in both directions. What do we call that? So if you have upside crash risk and downside crash risk from an options or rather a statistical perspective, do you know what we call that? Two-sided crash risk. Do you know what we call that? It's called kurtosis, right? It's called fat tails. But the frequency of upside crashes is actually higher than the downside crashes. So you have more frequent upside crashes in the stock than you downside. So you have kurtosis and you have skew. And the reality is the kurtosis, I would argue the option prices are still underpricing their kurtosis of these stocks. Kurtosis just means you have fat tails, meaning the probability of large, big moves is higher than a normal model. So I do like this. I don't like owning these stocks though. When you have kurtosis, when you have very, very high, not just skew, but you have just high crash risk in both directions, which these high short interest stocks frequently have. They're not great stock ownership stocks, right? And you're just playing with fire, and hopefully you can just put the fire out before you get burned. It's all you're hoping for, right? Because the moves can be furious and big any given day, right? So look at my GP Industrial over here. Stocks are now estimated down 6%. Come on, took away my. I keep taking away my link. But SYM right now, but this could drop to 40 tomorrow, right? Back here we went from 64 down to intraday 47. We dropped 30% in one day, right? So these companies are just ones where they're highly, highly volatile. They giveth and they take it away just as quickly. All right, they giveth quickly and they take it away quickly. RR, is this on the beginning of a big short squeeze here? Well, let's take a look, right? I mean, so again, when you look at this stuff, you realize, again, you can capture them, right? If there's liquidity, but this stock has 21% of the float short at 2 days. The days to cover is not super high here. That's big, right? Are we just about to see a big move in RR? I think it's interesting, right? So today we got a nice move. We've been consolidating for a while. Look at volume kicking in here, right? $2. I want my $2. What movie's that, huh? I want my $2. $2 stock. Big volume today. What about the options market? Let's take a look. Let's go to the growth sprint scanner. I'm going to show you block trades, but I think this one's kind of interesting. Anything showing up here on the scanner? RR. Nada. Well, let's see if there's any sort of no options. This doesn't have options, but high short interest. Is this a stock trade? The paper boy, better off dead, yeah? French fries, huh? What's the street value of this mountain in RR? What does this company even do? They're clearly in it's a robotics company. This one's kind of interesting as a stock trade. What's the squeeze potential here? Two-sided risk, though, right? I'm saying don't trade these stocks. Well, you have to. That's your only choice. But the way you handle this is you say, look, this costs $2. It could go to 50 cents in a hurry, right? So you handle it by saying, whatever money I put in the stock at $2, I got to be willing to risk it all, right? So, but that you're not planning on risking it all, but you can't control the risk. This stock could be $2 tomorrow. It could be one today. It could be $1 tomorrow, right? The stock went from $2 down to 50 cents here. We went from over $5 down to $1.50 there. This stock could go from $2 to $1.50 tomorrow or $1 tomorrow. My following Big Bear AI, I frequently do. This is a stock that does see a lot of option trading. Does have earnings tomorrow, today after the close. I don't really like using option activity for earnings. But on occasion, you might consider. But today, are they buying calls or puts? Let's scroll over here. 3 of these, buying the 750 calls. These are because they're selling the 850s there. But look here, 13,297. That's exactly equal to the open interest. So again, are they closing that out? Closing that out. This is not super interesting, right? I mean, almost always the vol alert hits, and it's almost equal to the open interest. That's identical. Yeah, we've kind of picked up here to about 15,000, but anyway, you probably need to look and see. Okay, 13,000 in one print. Was it a closing trade? Possibly. So I like to see a nice little ratio between the vol alert and the open interest, 56.59, 56.59. So that might be selling the 850s, right? They might be buying back the 750s here, possibly. Maybe there's a little bit more trade in it. Nothing super interesting right now in Big Bear AI, but again, it's an earnings. Anything can happen. But remember, there's two-sided crash risk here. Big move to the upside or a big move to that. You could wake up tomorrow, it's a $4. Now, the question is, do you have enough skew in here to make it worthwhile? Can you buy something and sell something, right? 240% implied volatility. I mean, that tells you something, right? 249. And notice volatility is dropping out here, isn't it? You get out here towards 950. You can see volatility starting to increase out here a little bit. So you'd have to buy a 950 strike. What's the expecting of about $1.30? So you'd have to get out here and buy some. This is not a great stock right now to trade for an earnings, right? Just because the vol skew is against you until you get out here to 859. So you could buy an 850 and you could sell a 950 or 1050 out here. 850 is right there. And that gets you on the edge of the expected move, right? So if you buy an 850 and sell a 1050, you get at least 10 cents by selling the 1050 out there, but you're on the edge of the expected move. But if we get a boom up here to 1050, that option is kind of expensive. The 850, your break even comes when? 850, this is a pretty cheap spread. Buy deep and wide, 1 month, 4 strike vertical, 20 cent risk. Telling us again, that gets you about 12.5 cents out there at the 1050 strike. That ain't bad. But what do you need? You need greater than a 1 times the expected move. So if we crash to the upside, you get 2 times the expected move. That could be interesting, right? What about RGTI? RGTI actually has some significant option activity today. In fact, let me show you. So this is one of the things you can do with the console, right? I can do RGTI, and this is given all of my. Well, actually, I don't have any parameters in here, but notice what's going on here, right? 31,000 contracts. We're now up to almost 70,000 contracts and 18 open interest. Someone bought 30,000 contracts in one print minimum, right? And now we're up to 70,000 contracts bought on the August 15 puts. So if you want to see what's going on in the background here with RGTI, I'll show you, right? If you want to look here, go time and sales. You don't have to do this anymore, but right here it tells you the story, right? The 1450, 30,000 and 36,000. Now, what I normally do is once I see that print, I'd come in here and I'd want to look at this and I'd see, oh, wow, that looks like 69,000. So what's happening? We're selling the 13 and 13 and a halves and they're rolling it up to 14 and a half. Why would they do that? Because they want it to be connected. This has a 27 delta instead of a 14 or a 10 delta. And they're paying some money to do that. So whether you actually recognize that this is a rolling order or not doesn't actually matter because they're paying the bill here to the tune of 23 cents net to buy the 14 and a halves. So from a practicality perspective, if they're closing out the 13 and a halves, they're closing out the 13s and moving it to 14 and a half. Doesn't really matter. They're doing it as a debit trade in this case. So they're moving these up here on the put side in RGTI. Now, again, I just said, do you really want to short these kinds of stocks? Again, we double-sided crash risk, right? These are companies that have very fat tails, kurtosis. So my thought process with these kind of companies is this, that there's two-sided movement and this volatility is probably understated. We're expecting a $1.75 or a $2 move over the earnings, and guess what? $1.75 to $2 to move over there. $2 only gets you where? $17.77. Just looking at this, eyeing this. Just eyeing this right here. Does it look like RGTI could move more than $2 or $1.75? Does it look like RGTI, just eyeballing this, could move more than or equal to $2 or $1.75? Absolutely, right? Earnings did nothing there. Earnings did not much there. Again, earnings back here, not a whole lot. right? Hasn't moved a lot on earnings, but at other times the stock goes from one day closing at 18, the next day dropping to 10. Okay? Goes from one day closing at 12.72 to the next day closing at 16.40. It's a $4 move. So the idea is that, does anyone know something here? Probably not. I don't actually look at this stuff and say, oh, somebody has insider knowledge and they're trading on that. No, it could just be a hedge. But the mechanics of this are the same. If the price drops through 1450, guess what's going to happen? They just bought 69,000 contracts right here. Who took the other side of that trade? Eric, they rolled losing trade for debit. Doesn't mean it's a losing trade, though, right? We don't want to infer reasoning behind these, because this could be a hedge that they just moved up, right? It's just, can we say, at a minimum, we can say it's just a hedge, they moved up. But there's something mechanical that goes on here. This is what we call gamma, right? Gamma squeeze. Who took the other side of this? 2 trades for 69,000 contracts. Do you think the option maker could match up 69,000 contracts and filled in 2 different trades? 39, basically 39,000 in one trade, 30,000 in the other. I mean, look at this down here, right? Sorry, 36,000 and 31,000. Do you think in this instant right here, 930.11 or 931.51, that they can match up 31,000 and 36,000 contracts? What do you think about that? Market maker sells the puts. Exactly. So the reality is it doesn't actually matter whether this is a good trade or not. Why? It doesn't matter if this is a good trade because there's built-in gamma. So I call this a gamma level. How much of this is going to translate over to open interest tomorrow? At least 67K, unless we fill a close amount later today. But there are 67,000 contracts the market maker's on the hook for there. So how do they hedge? They've got to short stock. So Kevin's got it, right? Market maker has to short. Doesn't matter the motivation. Now, they may have been a little bit short before because they were these, and they probably had, again, same trader traded these, are now trading this. So the market maker is probably already short some delta, so it doesn't have to move the stock now. But guess what? We just bumped up the delta. And what happens if we break below 14.5? This is the magic that can happen, right? The magic that can happen here, and thanks, Sean, for posting that. The magic that can happen is all of a sudden we break through 14.5, and the market maker has to short increasingly more shares as that delta goes from 26 to 1, right? So now we're at 26. You have to hedge a certain amount of delta at that level. They've had to bump it up from 10 to 14. Now they got to hedge 26. 8 million short shares. So again, they had some probably already. Now they've got to bump that up a little bit. But all of a sudden, you go from a 26-1 delta. This is this week, 4 days. We see that drop below 14.5. Now we're talking the squeeze. Now we're talking a big, big push to the downside. So the idea is that the option activity is not a great indication of direction, right? Does someone trading that know the stock price is going to go down? Probably not. But if, this is what we're talking about, but if we break 14.5, there is a mechanism here that's going to push the stock hard to the downside. Does that make sense? It's called a gamma squeeze. And so the idea is if you were to bet on, and it is a gamble because we don't know what's going to happen, but it is an educated guess, right? That I don't know which direction it's going to go, but if it goes down, this option price may be relatively cheap because the crash risk right now, because of the option activity, is greater to the downside. So now all of a sudden, what can you do? Well, if I look at implied volatility, notice that implied volatility is rising, right? Out here, we're going from 140 to 139.5, 138, and we start to bump up here. We have negative skew on RGTI for the earnings. Well, guess what? Does RGTI have high short interest? Does RGTI have high short interest? You bet you do, right? Where are we at here? 17% of the float shorted. So is there a potential short squeeze if we come out positive? Yes. The volume here, the short ratio or days to cover, that's 54 million divided by the average volume. This is not as high because we're trading a lot of volume in it. They can cover those shares easier. But again, we still have some squeeze potential to the upside. But from my perspective, I'm like, well, if I'm going to take a gamble on the earnings, I don't know what the earnings are going to be. Would you rather bank on the downside, bigger move the downside, or to the upside? Well, I mean, you do have a lot of open interest in here, don't you? Okay, but I can see this one. So from my standpoint, why not take a gamble at a 1450 and say, look, if we hit 1450, if we go to and through, this could make a big move. We could probably go to 13.5 or 12.5, right? We could see one of those 50% declines on the earnings. And man, if I can risk 40 cents and it goes to 12.50, it's worth 2 and I paid 40. But here's better yet. Why not use the volatility skew to your favor? Because I can buy 139 and I can sell 140 or 145 or 150. So what if I bought the 15, buy deep and wide, 1 month 4 strike vertical, and I'm paying 45 cents for a $2 wide spread, and my strike's at 15 rather. My break even is at 14.55. So now all of a sudden my break even is less than what? It's less than a one times the expected move. If I get the expected move at $2, that means what? We're currently at 15.70. It gets me to 14.70. I'm virtually at break even, and I'm making money below that. Buying the 14.5 does not get me. If I get 1 times the expected move, it does not get me to break even. This does. So anything beyond 1 times the expected move is gravy, and I have a chance to make $1.54, and I'm risking 46. Wouldn't they lose both ways if the stock went up? Market maker? Well, but they're hedging. Market maker's flat, right? They're flattening their delta. They're going to buy and short stock to the extent that they have exposure on both sides. So if they have short puts and short calls, what's the net delta there, right? They're managing that delta position by going long and short shares of the stock. Okay? But again, RGTI today is an interesting one, isn't it? And so again, I'm like, we're using the console here. One of the best comments I heard to this morning was this. And I'm going to show you. So when you look at this up, we got symbol, we got side calls and puts, we got spread tags if they're verticals. I mean, there's a chance I might miss it sometimes, but it's basically it's traded within a certain time frame. It should catch both sides. So we have the strike price, the expiration, the locations, whether it was bought or sold. At that point, it crosses 2,000. We have the volume on the alert. So right there's a big one that stands out, right? Volume, this is the current volume for the day. Yeah, this is probably 10 to 15 minutes delayed. Doesn't matter. You don't need real-time data for this. Having a few minutes delayed data is not a big deal. We got open interest. We got the volume ratio. This tells us how much the volume is greater than the open interest. The higher the ratio, the more we can know it's opening activity. The delta, you don't really need it, but negative deltas, a bearish trade. If I'm talking about what? It would be a put. Positive delta would be a call. We have the sizzle. How much above the average volume at that point of the day when you triggered against the 5-day average. We got the percent change in the option, the stock volume risk, we got time and all stuff. And you can rearrange the columns if you want. So I want to shove this over here because my screen resolution is 720 because I'm sharing it. I can move the sizzle index over and I can sort and filter by any of these columns. That's a mouthful. So I'm going to come up here and say, look, I just want to see stuff they're buying. if I want to analyze a spread or something like that, then I can open it up, look at the stuff they're selling. I want stuff they're buying. I want block trades. I don't want to see stuff that's just gently crossing 2,000. I want to see that stuff that's jumping over 2,000, so I can get a picture of that. And we'll start with two here. Of that big trade, that big block trade. Block trade running thousands of contracts in one trade, at least 1,000 in one trade. That's what this fall for going over 3,000, because it's going to take a picture when it crosses 2,000. And I'm going to say, look, I want something that's seeing a big ratio. And here's the deal. We're going to go from 773 to 25. 25 high value targets. Some of these are spreads that I may have to break down further. If I don't want to analyze spreads, don't worry about analyzing spreads. We're looking for 10 prints a day. Okay, that's all we're looking for. We want to see 10 prints a day. That's it. And then from there, we want to structure 2 to 3 trades a day. And then from there, we want to take 2 to 3 trades a week. This does not have to be a massively time-consuming process. And the comment that Bruce M made today when he talked, he just typed in chat about this XLP trade that we're going to look at. Let me just sort by volume. Oops, wrong way. Scroll to the top here. 125,000 put contracts bought in one trade just off the ask, not at the mid and not at the bid, just below the ask price. 125,000 contracts were sizzling today. And his comment was, it's hard to miss. Think about it for a second. Bruce is like, well, here's a 125,000 contract trade. Hard to miss. How many of you did not see this until right now? Think about it for a second. How many of you did not see this until right now, this moment, when I'm showing you on the console? Bruce said, it's hard to miss. How many of you are seeing this for the first time? That can be rhetorical, right? I'm not expecting you to have to comment, but here's the deal. XLP volume is a spread. Okay? It's always worthwhile to check that if you want. Okay? So the point is that this is easy to see if you have the right tools. Okay? Now, if I were doing my old Thinkorswim scanning in one line, this would not come up on that. So our old methodology, because with the old scanning tool, you had to go layer after layer after layer, right? I'd have to go 1,000 open interests, 2,000 open interests, 3,000 open interests to build in and to bring in everything. How much time do you have? Well, this one wouldn't come in until you got to 3,000. Now all of a sudden what happened? I got to do 1,000, 2,000, 3,000, 4,000. Okay, finally PCG comes up on the list. This is right here. It is easy and it is blatant. Now, Calvin says it's a spread. Well, let's take a look. Okay. Now, does it necessarily matter if it's a spread? Not necessarily. Let's take a look. XLP. Was this part of a spread? The answer is yes. Right? Is this easy to see? The answer is yes. So you come in here, again, we know the Ghost Prince console, right? At the 78 strike. But why did it not bring in the other part of it? Okay, well, let's go XLP. So let's take a closer look and check here. It did not tag it. Did not tag it as a spread. Okay. Location, it did not pick up. Is that going to happen sometimes? Yes. But we picked up the most important part of it, the 78 strike. Now, I'm going to send out to find out why, right? Wow. Well, it should have picked it up. Did it matter? No. Because what are we doing? We're buying this. Just the ask was 66 cents. This down here, the 40 cents was 9 cents off. This is what kind of spread do we call this? What kind of spread do we call this? And again, you could have easily seen this already, right? You don't need time of sales to see that, because we already knew 17 oct. And if I come in here and I see 125 and 125 there, what does this mean? Why did it not show up on the console as a spread? Well, I can see right here what happened. They closed those 75. So if I send and say, oh, why didn't it not show up? Because the volume is less than the open interest. This was not a spread trade. It was a roll. And they rolled it at a debit. They rolled it for what? About 30 cents, a 30-cent debit. 125 cents contracts, 1,000 contracts. Doesn't matter that it's a spread, that it was a roll. So I would normally tag that as a roll, right? And I did not in my I should have. Sorry. Kind of quickly did this before. I did not tag this a roll. Doesn't matter. The answer is no. Why doesn't it matter? Because what happens, this now becomes the gamma level. Whether it was at 75 before and now it's at 78, doesn't matter. We go to and we go through 78, guess what's going to happen? It has the same effect of whether it was not a roll or it was. Okay? So we still have a pretty sizable notional value trade here, 35 cents times 100 times 125,000. So yes, this is a roll, right? We're closing out the 75s. We're moving up to 78. This will not tag it as a spread because why? Because it only tags vertical orders where the volume is greater than open interest. So a roll doesn't exactly matter, right? It's still a bearish, or in this case, a bearish trade, or if we did it on the call side, it'd be a bullish trade. And we have our new gamma level at 78. Okay, does that make sense? So we could go through the rigmarole of saying it's a rolling trade, and yeah, I posted on my activity log RGTI roll, a Unity roll, but I did not put it in there as a roll for XLP. Again, sometimes you hurry and you make mistakes, but in the end, it doesn't change anything with regards to the spread trade itself, because the effect is the same regardless, right? So that would be the 75. Does that make sense? So good catch. So when I see something like this, this is what normally I do if I'm not in a rush. So if I were to see a big print like this, okay, 125,000, I would just come in here like this, and I would just go to Thinkorswim, and I look at the expiration and see, okay, does anything look like we're tying in here? And I just say, oh, yeah, notice this right here. Volume is less than open interest. That's not going to come up on the search. It's not going to tag it as a vertical. And they're opening this, they're closing that. So it's simple, right? Everyone has this data, right? Volume and open interest. And so it's easy to see it on occasion. Sometimes they might be rolling expirations. And so I look at other ones. And if you have time and sales data, it's easy just to open this up here, just uncheck it and find the big prints. Because just realize these are big block trades. These are easy to see. Does that make sense? Okay. Yeah. So, but even with this spread, there's a gamma effect. But again, the roll does not change the fact there's huge gamma at 78. All right. So now how do you translate this to a trade? This is an ETF. So let's look at XLP right now. How many like the technical setup for XLP? On the bearish side, by the way. How many like, so here's my thing. This may look like a fire hose. Okay. So if I uncheck 790, this may look like a fire hose. It's not. A couple of clicks and you just turn the spigot off. There's not many services out there where you can turn the spigot off. And the reality is there's stuff going on in the background here that are pre-filtering this stuff that helps you just cut through all the noise. So if you were on X, I remember Bespoke contacted me about posting stuff on option activity. And I went in there and looked at the stuff they're doing already. And I'm like, these guys have no idea what they're doing. I use Cheddarflow. Someone recommended it several years ago. I subscribed to Cheddarflow. I'm like, this is garbage. How do I cut through the chase? And then you watch what they're posting, not to disparage other services, but then I watch what Cheddar Flow's posting on X. And I'm like, you're posting a trade that's likely a closing order. I actually chatted them once or twice. I'm like, how do you know this is an opening order? They never responded because they don't know what it means, right? So you have people that are developing this stuff that don't actually know, and they don't know how to recognize this stuff. All they do is call attention to big stuff that happens, and it may not be impactful at all on the actual stock price. So with here, I'm pre-filtering this stuff, right? So in a couple of clicks, I can easily just go say, look, I just want to find stuff they're buying right now. And I have this stuff here so I can do some other analysis, but I just want some big block trades here. I just want to see these, and I want to find these high value targets, right? And also we go to 26. So let's talk about how to trade XLP. Do you like the setup here? I mean, Dave's boy says I do. We have a price trading in a range. We just had a rally. We're up against the resistance. I had an email earlier over the weekend about, how do you gauge significance? Was it tested how many times? To be honest, this has been tested once, twice, 3, 4, 5 times ish. 5 times in the last several months. Here's the question, though. If we've tested 5 times, does that make it more likely to hold as a resistance? What do you think? Okay, so on XLP, let's take a look. Now here's the deal, though. Does it make, we've tested 5 times to make it more likely this resistance is going to hold? Here's my assessment. Marginally, right? Most people say, oh, I got so many tests, it's for sure going to hold. I would suggest your probabilities after looking at charts for over 20 years, right? I'm a CMT. I used to write up until a year ago because they launched the new curriculum. I was writing test questions for a test prep company, and so I stopped being a SME for the CMT Association. Haven't gone back because I don't really want to do it. I've done it for years. Again, my experience is that, look, yes, you might marginally be more likely for it to hold than not, maybe a few percentage points. But the idea is, what I like, though, is the fact that, look, we made a big rally here. And if we set up a bearish position, there's a decent chance we're going to see a pullback here at some point. So, yes, we may break the resistance first and then break down. But I like the idea in the next 30 days, 30 plus days, that we can see some degree of down movement here. And from an option pricing perspective, and Corey's in the house, I got to pass the ball to him here in just a sec. I like to go 30, 45 days. So boom, 17 SEP right here. I have not traded. Some of Ghost Prince did. Bruce M brought it up, and some others took the trade. I've got a number of bearish trades on right now, so I don't need another one. But I said, hey, if you're looking for one, this seems pretty reasonable. Notice what's going on right now. $82. The volatility of the 82 strike is 11.5, 12.5, 13.5, 14.5, 15.5. Huge volatility skew because this is only a product that has 15% implied volatility. And the 82 has 11.5%. That in percentage terms, that is a big, big difference. So what do we do here, right? Let's go to 82. We're going to buy deep and wide, 1 month, 2 strike vertical. It costs you 55 cents. We're buying the at the money strike. My break even comes at what? 81.45. Looking at the chart, my break even's right there, 81.45. I need very little downside movement. If we test 80, you're out of the spread pretty easily with a 70% return. Very high probability of breaking by expiration. Very high probability getting to 80 in what? The next 39 days? You have greater than a 50% chance of expiring, of touching 80 at some point in the trade. And you don't even need it to get to 80, by the way. Take 55 times 1.7, and you're out at around $1. And you probably need to be somewhere in here in the next 30 days, 39 days. Okay? So again, that gives you an idea if you're looking for a bearish trade to put on staples. And guess what? This is on the heels of Friday. So if I'm going to go back to Friday here, I'm going to type in Walmart, clear the filters out, Walmart. Guess what? On Friday, there was a big 10,000 contract bought, right? That's the ask. That's the bid. That's sold. That's bought. For this week's expiration, they bought the 104 puts, 10,000 contracts. What's the top holding at XLP? It's Walmart. Earnings are coming up on August 21st, though, just as an aside. Well, folks, I hope this has been helpful for you. Again, I'll wrap it up there. Corey's ready to take over, so I'll stop sharing. Sorry, Corey, went 2 minutes over. But anyway, Tim says bought the 82.80 for 54 cents. Looks pretty good. Corey at the close.